Predictions that the global economy is heading for a recession are premature. The world's leading economists spent most of 2022 convincing themselves that if the global economy was not already in a recession, it was about to fall into one. But with the year's end, the global slump has been postponed to 2023. Clearly, the report that the US was in a recession during the first half of the year were premature, especially given how tight the country's labor market is. And despite the confidence with which many again proclaim the inevitability of a downturn, the chances of one in the coming year are well below 100%, but owing to the rapid interest rate rise by the US Federal Reserve and other big central banks, there is something like a 50% chance of a recession in 2023 and a 75% chance of it happening at some point during the next 2 years. Europe, hit hard by soaring energy prices, is more likely to head into a recession, which conventional wisdom defines as two consecutive quarters of GDP decline. China, however, seems in even worse shape. It has the same problem as Europe, plus a collapsing property sector and soaring COVID-19 cases. Owing to the Chinese government's recent decision to reopen the economy without a sufficient vaccination push. While China's growth next year is expected to be far slower than the historic pace it has become accustomed to over the past 4 decades. It's unlikely that its GDP will contract for 2 quarters. After all, even an 8 percentage point decrease in Chinese GDP growth during the peak of the 2008 global financial crisis was not enough to cause its domestic output to shrink in absolute terms. This is yet another example of the flaws in defining recession by the rule of 2 consecutive quarters of negative GDP growth. Moreover, many countries' current economic woes are self-inflicted, owing to policy errors that have been as harmful as they were predictable. Between 2011 and 2021, for example, Europe needlessly deepened its dependence on Russian natural gas, leaving it exceedingly vulnerable when the Kremlin launched its war against Ukraine. Likewise, China's draconian zero-COVID policy came at a high economic cost, while the absence of a plan for how to ease pandemic restriction means its containment strategy merely postponed COVID mortality. The US, for its part, has made numerous mistakes, including allegedly relinquishing its leadership of the Liberal International Order and ignoring the World Trade Organization and the trade frameworks that its members had negotiated over many years. Donald Trump's tariffs were wrong, yet Joe Biden has done little to reserve them. In fact, the Buy American provision in his otherwise laudable Inflation Reduction Act flout WTO rules. While the expected adverse effects of higher interest rates are not yet evident, there are signs that the everything bubble has finally burst. US stock prices peaked in January 2022 and have been trending downward since. Bonds, real estate, and emerging markets assets are all down for the year as well. In July 2021, I argued that there was a 90% chance that the asset bubble's domination financial market would burst. Historically, high valuation relative to dividends, earnings or incomes were an obvious indicators, although real and even nominal interest rates were zero or negative this time last year. A low discount rate meant that virtually any asset price level could be rationalized as the present discounted value of future income. This year began with 4 kinds of assets more clearly screaming and bubble. Meme stocks such as GameStop, cryptocurrencies, NFTs, and special purpose acquisition companies Each was innovative, although not necessarily in good way, and all collapsed by the end of the year. But should save investors see this declined as opportunities and buy the dip, given that stock prices are not yet back to where they were 3 years ago. On the eve of the pandemic, it's reasonable to assume that they may fall further before they are in line with economic fundamentals. The same might be said of cryptocurrencies, which have no fundamental value whatsoever. While next year will be rough for the world economy, the coming slam probably should not qualify as a recession, even considering that the two consecutive quarter criteria is too narrow. Global growth in the post-war period has seldom fallen below zero for a single quarter, let alone two, by the measure that severe oil shock and the downturn of 1974 and 1981 do not qualify as global recession. Even in time of apparent recession, positive growth among emerging and developing economies tend to outweigh advanced economies. Negative growth, the two notable exceptions being the 2008 global financial crisis and the 2020 COVID-19 crisis. While the Organization for Economic Cooperation and Development and the International Monetary Fund expects global growth to plunge to 2.2 and 2.7% in 2023 from 6.1 in 2021. That still leaves the world economy unlikely to shrink from consecutive quarters. Even if we adopt less strict measures of defining a global recession, such as a decline of GDP growth below 2.5%, a 2023 global recession is hardly a foregone conclusion. It is possible, of course, but it's also entirely avoidable.